the previous week closed bearish, I expect the next week to close bearish. Why? Because if you look at the chart, this happens time to time. If you close bullish, the next week generally closes bullish. If you close bearish, the next week generally closes bearish. There is a little more nuance in that. I've done the back testing, and this was part of the conversation that I had earlier that I completely lost. But if in one of any of my, I don't know, I have links in some of my descriptions, but in one of them I share my trading journal. It's open, it's out there, you can review it, you can see whatever you want. But in one of them, in one of the tabs, I have a like a 2CT or testing, it might be called 2CT, where I just went through, and I think it was the daily. It might be the daily time frame that I was doing, but I have no doubt that this is generally how it is. I would take yesterday's daily, and I would say, okay, if yesterday's daily was bullish, I'm expecting the next candle to close bullish, and I just tracked that. I think I tracked a few other things as well. Maybe it was 4 hour, but just doing yesterday's candle or the previous candle and this current candle, what do I expect it to be? If you were just to do that, I think if you look at the top, there's a percentage up there of how often I would be right or wrong. I think the win rate for that is like 51, 52%. So there's an edge, and that's trading. We're trying to find an edge, however small, whatever it is. The edge can be very technical, like that, like next candle, previous candle. The edge can be taking opposite candle colors off of bounces of resistance, EMAs, trend lines, whatever. Like, those are all technical edges that you're trying to find. Then you can have intuition in there, just your patterns that you've seen over and over again, whether it's around technical trading or just straight price action and the way the market's moving. Combination of both. Like, this is a science and an art, and it's a lot more art. And so you can have all sorts of different ways to do it. Now, I was not tracking, like, okay, when you lost, how often, how much would you have lost if you got in at a certain point and your stop loss was XYZ, and how often would you win, if whatever. It wasn't that. I was just looking to see, is there a little bit of an edge predicting the next candle based upon the previous candle? And the answer is yes. Statistics show it. The data's there. I did all that for myself. I was just trying to find a different way to capitalize on that now. Okay, I already have somewhat of an edge just by going in the same direction as the previous direction. Okay, cool. How can I find out a better way to increase my odds of winning? And so that's where this process of the two candle. What is wrong with you? Okay, that was fun. I don't know why I thought I was talking to it, but I wasn't. Wanted to find a better way to see if I could increase my odds, and I have. So that's what I do. I work on the weekly, and I use the 4 hour. I also play a little bit with the 4 hour and the 5 minute, 15 minute every now and then, and also the daily and the 30 minute, depending on the pair and depending on what is actually going on. But generally, I will start with the weekly. That'll at least give me what I'm looking at for the entire week. And if I'm trading all my 27 pairs, going anything less than that on 27 pairs is way too much. So this gives me the opportunity to be able to just sit back, relax, set some stuff up, and not have to really worry about anything. I like it. It's simple for me. That's the key. You got to find something that works for you. So I mark up the close of the previous week and about 50% of the body. If I don't have a body like OddCAD right here, we have more of a 50% wick. Or more of a big wick. I see that as a rejection wick. I still see the bears being in charge of this market right here. And so I'm still looking for that. Now, generally, looking in previous charts and everything like that, generally, you still have some sort of wick creation. Hardly ever. I think you might have maybe 2 candles out of the 10 that are on here, I don't know however many, that don't have wicks, either bottom wicks or top wicks. So the odds are with you that there's going to be some sort of wick creation. These are all things that's okay, I see this happening over and over again. These are patterns that I'm trying to pick up on and trying to use to my advantage. So I'd mark 50% of that wick, drop down to the 4 hour, And when price gets into that area, the zone that I marked out, I'd wait for another bearish candle because I need market start moving in my direction. Once I get that bearish candle, it's sort of tagging onto the 2-candle theory. That's basically, I'm like, okay, cool, let's set it up for everything that's going to go on. Set up a sell stop, put my stop loss in place, and go. So AUD-CAD, that's what I'm looking for AUD-CAD, is a sell. Let's move on to Euro USD. Euro USD. I'm also, what happened here? I'm looking for a buy? No, I'm not. I'm looking for a sell. Why am I looking for, yeah, I am looking for a sell. But yeah, actually that's a really strong bearish candle. So I'm looking for a sell. I just don't know why I have a box there. I don't know where that happened. But I'm looking for a sell. Two things here. There's really no bottom wick yet. So with that being said, price might actually pull back farther than the 50%. Where would I mark out? I'd mark 50% of that body, and I'd mark 50% of the previous of the wick as well. Those are the two areas that I'd look at, because sometimes price will pull back when there is no wick of the previous candle. Price sometimes will pull back even farther. So I just want to be prepared for that. Generally, though, when that tends to work out, the zone for my 50% body doesn't even get there. Like, there is no bearish sentiment there. It will just blow right through it. And so I'm just prepared for the next zone. GBP-JPY. GBP-JPY, I would say, I would look and go, okay, yeah, it's supposed to be bearish, but thinking about the way that this candle played out, the market opened, the sellers pushed the market all the way down, buyers came back in and pushed the market all the way up to more than the actual body that's left. That's a huge fight that has happened. And so what would I do at this? Well, I would look at this, same thing, 50% of the body, but I'm also going to do 50% of that bottom wick. And all I want to do is I want to make sure that if I got into a trade, that if price was to, I want to be able to make price, I want to be able to bring my stop loss to break even. So a 1-to-1, when I get to 1-to-1 at that zone, at the 50% area. There was an example before, yes. So if you look on the far left of my screen, right above the T, you'll see a very similar candle to the one that I'm talking about for the weekly. And if you look, the very next candle, instead of being bearish, closed bullish. But what happened though? The candle opened, at some point in time went down to about 50% of that other area. Now, whether or not it went up first, it would have triggered me in and then got down to 50%. I don't know. I'm not going to drive down to that. But that's generally what happens. I'll either get an opportunity to see price react off the 50% wick area, which could tell me that actually price might not be going down. It might actually be flipping here. But those aren't the type of entries that I take. And I might want to be out of that trade if I happen to be in it already. So that's how I would play this one. NZD-CHF. NZD-CHF, this was the one that I actually used an example of the previous week. So we have a strong bearish candle that closed last week that engulfed the previous week before that. So 3 weeks ago was bullish. The 2 weeks before that closed bearish, but completely engulfed the body, and I think engulfed the wick. Doesn't really close enough. Now last week's candle, following 2-candle theory, would expect to be bearish, but it never made it to 50% of that previous body. And sometimes that happens. Because the momentum is so strong, you don't get a 50% retracement of the previous body. So what would generally happen there? Well, if I had a strong bearish candle like that, I'd mark up my 50% because, you know, sometimes it happens. It still comes back. But I'd also look on the lower time frame, on the 4-hour, and see if there's another zone that might be there where price could test and I could still look to get into a trade. So dropping down into the 4-hour, you're fired, because that's not what I did. I must have touched that wrong. Dropping down to the 4-hour, we see there's my weekly zone, the 4-hour, which lines up very, very nicely. This is what I'm talking about when I drop down to the 4-hour and I see what lines up with the 4-hour structure. That lights up beautifully nicely with right there. But then here is like where price pulled back, what did I just do? Why is that in my way? Stop it. Let's get you out of my way. Okay. So in this area right here, price came up and decided to reject off. Now, I don't know what I would have had. I would have had to wait to see how actually price started to form. Once I got this bearish candle, it's like, could I have taken a trade? Now, I wouldn't have taken a trade just because of how far that candle pushed away from that zone to begin with. I wouldn't have been able to set up a trade. How do I set up my trades? Once I get a bearish candle in the zone that I'm looking at, I will go 1 ATR away from that candle based on the 4 hour. And I'll use my stop 1 ATR above the zone that I drew. And I'll set up a buy stop or a sell stop for this one. And if I get triggered in, I get triggered in. If price is going to continue bearish, it should trigger me in and continue going. If it's not going to, for whatever strange reason, then I just want to be able to be out of it. But I don't want to be out prematurely. If for some reason that zone is still a valid zone, price may come back up. It may have triggered me in and come back up and retest. And I don't want to be kicked out early just because I had my stop loss too close. Hence the reason why I have an ATR above that zone. And so it sort of gives me the ability to allow price to fluctuate enough to make its own decision, but then also still protects me enough to not be into a trade that I hope will win. Because if it breaks above that zone in ATR, I'll also close it early. If it actually closes above that zone strong, then I'll close it early too instead of waiting for a full stop loss. Just because I've seen the data for me makes that work. I end up being more profitable than most, more profitable than most losses, and that's really what it's all about. You're not going to find a trading strategy out here that is 100% win rate. If anybody had a trading strategy that was 100% win rate, I'm pretty sure it'd be someone like Jeff Bezos or Elon Musk, who already has like buku amount of money, and you just think that they got it from, it's crazy. Like, who, to be in the mindset of wanting to find a win rate that wins all the time doesn't exist. And if it did, they're not teaching you it on YouTube, and you're not gonna find it because it doesn't exist. So, it's all about finding what you can make work for you. And so you need to find a strategy. You need to find somebody to teach you something. Either you can learn on your own, or you can find somebody who has broken it down enough for you that you're like, I understand the way that this guy or this girl teaches it. Grab that strategy. Now, the best advice I can give you is, once you have the basics of that strategy down, you need to take time just for that strategy. So you need to shut down YouTube, Telegram, WhatsApp, Facebook, wherever it is that you get your influence from trading, you need to shut it down. Even from that guru that you learn the strategy from, shut it down. Now you need to take the time. If you're on the 4 hour, take about a month and a half, and just dive in to trading that strategy. Learn the ins and outs of it. Get all the data that you can around all of those trades. Review that stuff. Find out what's working, find out what's not, tweak it for yourself. And then from there, just move on. Because if you have tweaked it for yourself and you've realized moving forward that it is profitable, you don't need anybody else. You can play around and watch other people and, take in other stuff to see if you can incorporate it in. But now that you have something, you can just work with that. You're profitable. Move and grow. Start putting money into it and move on from that so you can work on other parts of the psychology, because the strategy is not it. It's the psychology around trading is it. If I gave you a strategy that had a 70% win rate, you wouldn't be able to trade it just because you haven't built up your psyche. Like, you would lose it. You would. It's just because you haven't put in the time to build up your resilience, your discipline, your patience, watching out for FOMO and greed. You haven't built all that stuff up. You have to get into the markets to do it. I used this analogy before, and I'll use it again. You can get, like bike riding, you can get all the information in the world. You can get professional bike riders teach you everything that you need to know. You can watch all the YouTube videos. You can read books. You can write papers. You can write dissertations on, I don't care. You can do everything that you want to know. You will not be good at it. You will not learn what you need to learn until you yourself actually gets on that bike, learns how to balance, learns how to steer, learns how to focus on what you're going, what you're doing, paying attention to things around you, learn how to pedal, learn how to brake, you got to learn all that stuff. But that only comes with experience. Trading is the same way. So if you find yourself just scrolling through Facebook, finding all these different videos on trading, but you aren't putting equal, if not more amounts of time into your own trading, you're doing it wrong and you're not going to be successful. I'm sorry, it's not going to happen. So do that. If you already have all of your data, you've done the due diligence, and you just want like an outside opinion, you want somebody to be able to look at and go, hey, what can I do better? Join me on Discord. It's not meant to be an active community where we're all like talking and blah, blah, blah. It's meant for people to just come on in, either ask for like, hey, how can I get started? Who would you recommend for an easy strategy? I seem to like trend lines. Okay, cool. I have this person I think you might jive with. I like support and resistance. Okay, well, I have this person you want to go watch some of their YouTube videos, take some notes and everything like that. I like this idea of smart money concepts and the market makers and liquidity and stuff like that. Okay, well, I have somebody else you can go spend 40 hours a week learning from, because that seems to be a whole lot of work. I don't like smart money concepts. I have the course, but it's a whole lot of work and I don't feel like putting in that time. Why? Because I found something that works. I have steadily grown my account from a simple 100, 150 to I work with a $2,000 account right now. I have pulled money out of the market. We've paid off credit cards. We've paid off the cars, and now my current goal is to build up my account enough where I can make consistent withdrawals to start taking over a bill, like start taking over the water bill, $50, $60, the water, sewer, and everything we ever find, taking over the electric bill, however much, taking over the mortgage, to consistently do that, while at the same time still being able to grow the account. I don't want to just pull everything out and just work with $2,000. No, I want to grow that account. Why? Because everything becomes exponential. Once you find that you can pull 3% out of the market every month, 2%, 1% out of the market every month, the goal after that, if you find that consistency, if you're between like 1 and 5% every month, 1% every week, whatever, if you can consistently pull that out of the market, the next step is growing up that account so that your withdrawals become bigger. Yes, there are what are those funded accounts out there? Got it. Cool. They have so much red tape around that. I'm not sure. I probably won't do it. I will be doing my own funds, because I want to be able to make it work for me. I don't want to use somebody else's money, pay with somebody else's money. I want to be able to work for me. It, number one, helps increase your, like, can you imagine being a paper trader or a low account trader starting with $1,000, $2,000, and you're placing trades, and then all of a sudden you're like, you know what, I can go to this funded account, and they give you $50,000 to trade with, $100,000 to trade with, and now all of a sudden your position sizes, like, unless you have the psychology to handle the fluxes of money and losses, I don't. And so I know that about myself, hence the reason why I'm not going to do a funded account. You need to learn that about yourself. So if you need to learn some place to start, by all means come. I'll try to figure out something about you and see what works for you. And then I just want you to ghost. Just go ghost and just start putting in the time and effort into whatever strategy that we've tailored for you. If you have the data and you're like, I just want an outside, you're like, I want to find out, like, it's sort of working, maybe it's not working, maybe I'm a break-even trader, what can I do better? Well, let's aggregate that data together. Let's look at it and go, well, have you considered X, Y, and Z? Have you thought about X, Y, and Z? I'll be there for that as well. So I post most of my stuff